My name is William Holland, Alphapack leader, William Holland Jr., aka Boss Gang VIP. And today we are going to be getting to the subject of stock investing basics. So I went ahead and put some things together that I believe all investors need to know. And if you don't know these things, um, you're going to know them by the end of the day. We're going to figure out how to break these things down like hedge funds do. The most basic thing we want to get into is simply what is a stock? What is a stock? We trade stocks, but what actually is a stock? A stock, also known as equity, is a security that represents the ownership or fraction of a corporation. This entitles the owner of the stock to a proportion of the corporation's assets and profits equal to how much stock they own. Units of stock are called shares. What is a stock? A stock is ownership in a company. Before investing in stocks, it's important. You hear this term brought up many, many times. The term is due diligence or DD. So we know what a stock is, and we want to understand due diligence. Due diligence is what we need to do with any investment we make, whether it's stocks, bonds, real estate, or the like. What is due diligence? Due diligence is an investigation of a potential investment, such as a stock or product, to confirm all facts and to ensure the purchase will meet the buyer's needs. When you make an investment, you want to know if that investment is going to meet your needs. If you do not know if an investment is going to meet your needs, you should not be making the investment. You should do more due diligence. What we want to do is measure 10 times, cut once. You should consider a variety of factors when performing due diligence on a stock, including company capitalization, revenue, valuations, competitors, management, and risk. By taking the time to perform due diligence on a stock before making a purchase, you'll be better equipped to make a decision that aligns with your overall investment strategy. So one of the things I like to mention to people is knowing your risk profile. When you sign up with the brokerage, one of the first things they want to ask you is what type of investor you are. What is your risk profile? Are you conservative? Are you moderate? Are you aggressive? Are you looking for immediate returns in 1 year, 2 years, or 10 years? Does your investment need to be liquid? Meaning that if you need your money back immediately or in a short amount of time, will your money be available to you? These are the things you want to know before you invest. You want to know if the things you're investing in are meeting your goals and if they're going to meet your strategies that you have over whatever period of time you're looking for. Some people might have goals for that day, that week. Some people might have goals. Maybe you invest in land and your goal might be to hold something and pass it down for 100 years. Whatever you're investing in, you need to make sure that it meets your goals. Some things that we talk about when we're doing due diligence on these companies. One is company capitalization, also known as the market cap. Simply, how big is the company? Are we talking about a startup company, or are we talking about a big giant company that has trillions of dollars in assets that's been around for 30 years? So when we're investing in these companies, we want to know what the market cap is. We also want to know the revenue and margin trends. So is the company making money? And are the margins growing? So if a company is making money, generating revenue, and the margins are going, the margins is actually how much we make, the difference between what we spend and what we actually get to keep. What are the margins that we make on our products? You know, if we sell something for $1 and or we buy something for $1, sell it for $2, we have a $1 margin. Now, what the companies will try to do instead of trying to get that margin from $1 to $2, to try to make it go from $3 to get it to the $2 margin. So you want companies that are consistently increasing revenues and increasing margins. Number three, the third thing on the list is competitors in industry. What industries are we in? And if you trade stocks with the pack, that is a big thing, knowing about the competitors, the industries that they're in. Maybe you'll have a Coke, you'll have a Pepsi, you'll have a UPS, you'll have a FedEx, you'll have a T-Mobile, you'll have a AT&T and Verizon. So you'll have a Lowe's, you'll have a HD. You want to know about the competitors in the industries. Valuations. The fourth thing, valuation multiples, overall the stock value. Later on, we're going to get into different factors that make up stock value, but definitely you're going to want to know what something's trading at. And we'll get into that in a little bit. You want to know about management and ownership. I'm a big sports fan, and I understand the importance of leadership. I understand the importance of coaching, and that the people that you have in charge are ultimately going to make the biggest difference in the success of a company. That's the reason why some of these CEOs get billions and billions of dollars. A stock will tank if people do not like the CEO, and a stock can shoot to the moon simply based on the new leadership that might come in. So leadership, management, ownership, that is definitely an underrated um, part of investing. Um, One of my favorite companies is Salesforce, ticker symbol CRM. One of the reasons is because I like the ownership. I like Mark. I like his competitive attitude. Um, I like how he's willing to step forward, and he's willing to take the blame for anything that goes wrong. He's definitely confident. He believes in himself. He believes in what he has to offer in the company. So when you have that type of ownership, it gives you a lot of confidence, and that's the type of ownership that I'm looking for. Number six, balance sheet exam, debt equity ratio. How much debt does the company have, right? So, um, if something has a lot of debt, you want to consider that definitely before investing. So, right now, a lot of the opening plays that we might have, things like airlines, because we haven't had the travels and whatnot, they have large amounts of debt. So, for people looking to invest, those are factors to consider definitely. So, you don't want to make an investment and then turn around and then have to do diligence, and then you're losing on your investment and you don't actually understand why. Number seven, stock price history. What we want to know is price action and volatility. So I like to get as much data on my charts as possible, max data. I look at charts from left to right. Is the stock going up? Is it going up and having big drops? What is the price action? I like to invest in things that are kind of steady Eddie. You look left to right and they go up. So you want to know about the volatility. What is the actual price action? So does the stock move up and down really, really fast, or does it move really, really slow? Um, you want to know about when are the volatility, as in things can go up really, really high. Um, Maybe like a Tesla, or go up really, really fast, and they can also fall really, really fast because they're volatile stocks. Whereas you'll have stocks like XLP, consumer staples, that are pretty much left to right. They go up, they pay dividends, and they're pretty solid. Number eight, stock options and dilution. You want to see what's going on behind the scenes of the company. can read a lot of articles. There's a lot of things that are on the surface, but what we want to actually do is get into the stock options and dilution. So the things that are coming in the future. You don't want to invest in a company that has a scheduled dilution coming. We find these through SEC filings, 10Q and 10K. So I'm a big proponent of actually going through the paperwork. And all these, I want you people to understand, a lot of these things are people's opinions. We all know that balance sheets and things like that can be manipulated. So we're going to use all the information that we can as a whole to actually try to come up with the best thesis that we can for investing in these stock. What are some expectations for the actual stock? One of the things I like to look at are analyst price targets. So what are analysts saying about the stock? What are the market conditions? So expectations. So we might expect electric vehicles to be a big part of the future when investing. We expect that the metaverse and those involved in it in cryptocurrencies will be a big part of the future. So what are those expectations? Maybe a restaurant is changing their model from maybe hiring minimum wage workers, and their new models going to involve robots, artificial intelligence running the restaurants. What are the expectations for the company, and how could that change in the future? And then ultimately, we have to determine the risk, because this is what it all comes down to. Risk management. What are the risks involved? No matter where you invest, the very first thing they're going to tell you, all investments involve some sort of risk, whether it be minimal or maybe something significant. They all involve risk. So we have to understand that when we get involved, you may not win every time you take an investment. So we want to give ourselves the best chance to win. So what we're going to do is do our due diligence and manage the risk. So so as far as risk, setting this vital piece aside for the end, make sure that we're always emphasizing the risk inherent with investing. Make sure to understand both industry-wide risk and company-specific ones. Are there outstanding legal or regulatory matters? Is management making decisions that lead to an increase in the company's revenues? Is the company eco-friendly? What kind of long-term risks could result in embracing green initiatives? Investors should keep a healthy devil's advocate mindset at all times, picturing worst case scenarios and their potential outcomes on the side. This is an important point. Investors should keep a healthy devil's advocate mindset at all times, picturing worst case scenarios and the potential outcomes on the stock. A lot of times we get into these stocks and we have a very optimistic and bullish mindset. You know, we're going to put our money in, and we see people winning, and so we don't add any context to it. So we see the upside of things. Successful investors look to the downside. Before you can win, the number one thing you have to do is learn how not to lose. So you have to look at your investments and say, if my investment goes against me, how much will I lose? If you make an investment in the amount that you could potentially lose more than you want to lose, don't make the investment. So if you want to make $100 investment, but the downside is $100, unless you're willing to lose $100, don't make the investment. Now you might put $100 in and say, you know what? My downside is only $5, but my upside is $100. I'm willing to lose my $5 for the chance to make $100. I'm willing to do that. So I'll take the trade, I'll make the investment. If you're not willing to lose 100% of what you put in, don't make the investment. If you're not willing to lose 100% of what you put in, don't make the investment. This should not be an emotional decision. Your investment should be well thought out. Investment should be made with a mature mindset. If you're not willing to lose, don't put it in. Find something that fits your risk profile and what you want to do and how they're going to help you reach your goal. With that said, we mentioned earlier about stock value and analyzing these companies. So that's what we're going to get into now. Hope you guys got your pen and pads. We're going over the 4 basic elements of stock value. If you don't know what the 4 basic elements of stock value are, which you're probably thinking to yourself, I probably should know the 4 basic elements of stock values if I'm going to consider myself an investor. You're going to learn today. 4 basic elements of stock value. Financial statements can be used by analysts and investors to compute financial ratios that indicate the health or value of a company and its shares. PE, PE ratio, PB, PB ratio, PEG, and dividend yields are 4 commonly used metrics that can help break down a stock's value and outlook. Any single ratio is too narrowly focused to stand alone, so combining these and other financial ratios gives a more incomplete picture. I can ask questions. Well, how do you find these companies? And I always mention it's a combination of many different factors. So there's no one indicator, there's no one factor that is going to give you the end all be all answer. But you want to take all the knowledge that you can put together and create the best thesis, as I mentioned earlier. Number 1, price to book ratio, PB ratio. That is simply the current total value. What I mean by current total value, meaning if the company decided to liquidate all assets and decided to just, flat out get rid of everything. So Coca-Cola decided, I'm going to sell all our products. We're going to sell all our facilities. We're going to pay off the staff. We're literally going to get rid of everything. We're going to get rid of all of our trucks. We're going to cash out all of our contracts. That would be the actual current total value. That is the price to book, flat out. How much is the company worth if they liquidated every single thing that they had, and we came up with a final number. This number 2 thing is price to earnings ratio. You'll hear this one pretty common. This is a future prediction. You'll see this also referred to as multiples. Basically, what these are, a lot of companies, they can have a low PE ratio, a high PE ratio. It's all going to be relative to stocks in the industry, and it's not across the market as a whole. So when comparing PE ratios, you want to make sure you are looking at competitors or industry. So we might look at healthcare and compare the evaluations between Pfizer, Moderna, Novavax, and different companies, GlaxoSmithKline, and to determine the overall value. Some things are trading at lower evaluations. These future predictions. So with company things that are trading with high PE ratios, what people are hoping is that the company continues to make tons and tons of money in the future so that the actual PE ratios won't matter. So people are hoping Tesla trades with a really, really, really high PE ratio, one of the highest in the market. That's why it's, so easily, heavily shorted. Um, because people are betting on the future that Tesla is just going to do some amazing things. So it's not based on actually what they've done right now. This is a future prediction going forward. You'll hear a lot of analysts talk about these PE ratios and how they like things with low PE ratios relative to competitors in the same industry when they're looking at. So that's a common thing. Number three, price to earnings growth, PEG. This is the historical rate of growth. So as we can look into the future with PE ratio for future, we can look at PEG. How has a company done in the past? You can look at a company left to right, and you can see at the rates which these are growing. Another thing I like to look at is dividend yield, percentage of earnings paid to stockholders. So different stocks, popular dividend stocks like AT&T, not saying that's necessarily my favorite, but they're popular because they've been paying a consistent dividend over a long period of time. Although recently um, there was talk of cut. I don't even know if it's happened or if it was just talk. But there are companies like Coca-Cola, Pfizer, Abivai, just different companies that offer dividends. So when you're evaluating company and the value, you want to look at dividends as part of that value. If a company's paying dividends, dividends are paid out of profit. So a consistent dividend and a growing dividend is a sign of a good company that is going to be around for a while, and it's a sign that they have good management. So break it down, the PE ratio, PB ratio, PEG ratio, and dividend yields are too narrowly focused alone as a single measure of a stock. By combining these methods of valuation, you can get a better view of a stock's worth. Any one of these can be influenced by creative accounting, of course, as can more complex ratios like cash flows. Again, a lot of these numbers definitely can be manipulated, but we definitely want to get as much information as we can to make our decisions. Next portion we're going to get into when analyzing these stocks is fundamental analysis. You'll hear people talk about fundamental analysis, technical analysis. What we're going to get into is fundamental analysis, or FA, just like we have TA, technical analysis. Fundamental analysis is a method of measuring a security's intrinsic value by examining related economic and financial factors. Fundamental analysts study anything that can affect the security's value, from macroeconomic factors such as the state of the economy and the industry conditions to microeconomic factors like the effectiveness of the company's management. The end goal is to arrive at a number that an investor can compare with a security's current price in order to see whether the security is undervalued or overvalued. So a lot of time, what you're trying to do, I'm buy low, sell high. So I want to buy things that are simply undervalued. Warren Buffett has a statement. He tries to buy $1.60. You want to try to find things that are undervalued, that you see absolute intrinsic value there. So I would equate it to equity in a home. If you can get a home for $400,000 that is worth $500,000, you have a 20% or $100,000 in equity in that property. So it's an easy buy. It's an easy buy. I would, so value, we all know value. We grow up, we look at sale papers. Um, we know when things are good price. We can look at things and know when they're expensive or just more than we simply want to pay for them. I could throw out random prices of things and people could tell me flat out, um, that's a good deal. We all know the values of multiple different things. We know the values of tennis shoes, TVs, makeup, whatever it is. We know the value. So We just use our fundamental analysis, whether we even know that we're using our fundamental analysis. I'll give an example. We all know that during holidays, they'll have holiday candy. We all know that they're going to sell a certain amount and there's going to be a ton left over and it's all going to go on sale. It's going to be really, really cheap. That is fundamental analysis. These are things that the market conditions tell us. These are things that we actually know. Fundamental analysis is a method of determining a stock's real or fair market value. Fundamental analysis search for stocks that are currently trading at prices that are higher or lower than their real value. If the fair market value is higher than the market price, the stock is deemed to be undervalued and a buy recommendation is given. And so this is the basics of stock trading: buy low, sell high. If the fair market value is higher than the market price, the stock is deemed to be undervalued and a buy recommendation is given. These buy recommendations on stock from analysis, they're saying that the stock is undervalued and is worth a buy. If something is a strong buy, it is severely undervalued. We can look at, again, determining value, we can look at the expectations and analyst upgrades to find the best values in these stocks. So some factors you want to consider is the actual business model. If somebody say, how does a company make their money? For example, a company like GE, General Electric, ticker symbol GE. So a lot of people may look at GE like an appliance company or something like that. You might have a GE stove, a GE refrigerator. Going into the fundamental analysis, you understand that GE gets about 70% of their revenue from the aviation industry. Without actually going into the fundamentals and understanding the business model that these companies are using, you may get confused about what's actually happening with the stocks at the time. So GE would be considered a recovery play, with Boeing being one of their biggest clients. So you definitely want to understand the business model. That will determine a lot of times how fast a company will grow in the short term versus the long term. Is a company that gives out samples? So, for instance, PLTR, they give out their software and their engineering to different companies, and they let them use them for a trial. And they're hoping that once they see the benefits, that they'll sign a long-term contract. So initially, companies like PLTR may not have this initial income because of the actual business model. So when investing in companies, you want to understand the business model and how that will affect the company in the short term, as well as affect the company in the long term. Competitive advantage. What are some competitive advantages that a company might have over another company? It might be simply customer data might give a company an advantage. A company like Uber may have the logistics for a city completely all drawn out. That gives them an advantage and gives other companies a platform to build on. So you want to look at the infrastructures that people have set in place, the kind of things that people can build on. Just what is the actual competitive advantages? Competitive advantage, meaning they have lower shipping costs than their competitors. They have lower manufacturing costs, different relationships and contracts. Those are very important. Number three, very important, corporate governance. Who are the leadership and how do they actually run the company? How do the CEOs treat other employees in the company? How does the company treat the shareholders? Are they kind? Do they communicate with the shareholders? Do they send out the emails, or do they give you random dilutions without you knowing? Are your dividend payments consistent? Are they moving forward? Are they innovating? What is the mindset? How is the company a green company, like we mentioned earlier? Are they willing to adjust and be flexible? These are some of the kind of things. A lot of companies, they have management, you'll get stuck, a la Blockbuster, a la Tim Cook not wanting to deal with Apple, or with Tesla, with Apple cars. Some people get in their own way. So you want, and ironically, Tim Cook says it's a young man's game, so they're going to replace him coming up, and I would assume that the stock will go crazy because what people want is innovation. So you got to look for the customer governance, customer base. Apple is a good example of that. Coca-Cola is a good example of that. Like, who are the customers? Are they loyal? What is the ecosystem? Companies like Coca-Cola, so their customers might be McDonald's and just other large companies, baseball stadiums, football stadiums, arenas around the world. They have all these huge customer bases. You might have a t-shirt company like Hanes, for instance, that this customer base might be wholesale companies and different things like that. So if there are supply chain issues, then the customer base gets affected. Or if you're investing in real estate, and real estate, if are there customers, retail rental customers renting apartments, or is it mall space, like a company like SPG or something like that, or a company renting warehouses out to Amazon? Like, what are the actual customer base for these companies? You want to look at market share, how big, what portion, if divided into a pie, um, does the company control? Some companies in certain industries have really, really big market caps. Of course, somebody like Apple, or even in healthcare, companies that have big giant market caps, but then you'll have super small companies that are, we have billion-dollar companies, and we have companies that are worth $100 million, really, really small companies, 50 million, even startups with 10 and $20 million. So what is the market share? Business cycles. When do the companies actually make money? So I'm big into seasonality, and different things have different moves at different times. So that can be a big factor when deciding to buy stocks. So certain stocks will move better during the summer. Some stocks will move better in the fall, winter, and spring alike. Some stocks will do better based on decades and even things that are going on. So we definitely want to keep the market cycles in mind. And then, of course, the competition. Who is the competition? Who are you playing against? What are they up to? Can they possibly overtake us? I'm trying to decide. I'm trying to, make a portfolio, and I'm trying to decide, do I want Coke or Pepsi? I'm looking at the benefits and pros and cons on each side of that. I'm trying to decide between UPS and FedEx, or even companies, or if I'm trying to decide between Amazon and Alibaba, I want to know the competition and the advantages, different ways to have. In conclusion, there are many factors to consider before investing in stocks. The best investors make informed, educated decisions. Investing in stocks involves the risk or some or all of the capital invested being lost. Know what kind of investor you are, and know your risk profile. When it comes to investing, time is your friend. So that is going to conclude this portion of this segment. So I'm going to end the recording here before we get into the next part of it.